Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Jeff Dorman, Chief Investment Officer at Arca, to discuss why digital assets are needed to improve wealth inequality. Jeff, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me.
Let's discuss the concept of using digital assets to bridge the wealth inequality gap. Why does this asset class offer other things that traditional methods of accessing the capital markets do not?
Sure. Well, first, people need to understand that there's a lot more to this market than just Bitcoin, right? Bitcoin's exciting. Bitcoin can help wealth inequality in the sense that you're not going to be inflated to death through the US dollar depreciation. But there's also real companies and projects that are issuing digital assets. And why this is exciting is because it's turning capital markets on its head. Take the recent IPOs, for example. There's been a lot of IPOs of companies that are very well-known companies because there's lots of consumers, there's merchants, there's all these different components coming together who made the company work, but it's only the early equity investors who actually make any money on the IPO. Digital assets are different. The digital assets are issued to the consumers of the product, to the developers that are building the product, to the liquidity providers who are helping to stake it, whatever the case may be. Your constituents, the people who actually help make your company work, are the ones who own the wealth. And they're the ones who actually get to benefit when a company or a project succeeds. And that's why in digital assets, we've seen some of the fastest unicorns ever, companies that have reached $1 billion valuation. And it's because your customers and your constituents are the same people as your investors. There's no longer this dichotomy. So that can really help bridge the wealth inequality that we're seeing in America and elsewhere today.
Yeah, that's a really good point. Let's talk about Bitcoin for a moment. What has changed in the past 90 days with all the new entrants to Bitcoin from traditional finance?
Sure. I mean, from an actual macro or from a story standpoint of why Bitcoin is an exciting investment, really nothing has changed, right? All the factors that have been driving Bitcoin all year are still in place. The US dollar is going down every day. Interest rates are zero. Investors are basically being forced to put money into riskier assets. And obviously, you've got trillions of dollars being printed, both from monetary policy and from fiscal stimulus. So that hasn't changed. What's changed is the speed with which these investors are getting involved, right? They can no longer just sit back and wait and do their due diligence for 6 months or 12 months or 18 months. They're starting to panic and be like, okay, I've done the work, I understand it. Now I need to go get that approval and I need to get in now. And that's really the biggest change over the last 3 months. I mean, obviously price is exciting. It's doubled in the last 90 days, or actually more than that, it's tripled in the last 90 days. But it's because of the speed of the entrance, and there's just not enough Bitcoin to go around for all the different types of investors and participants who want a piece of Bitcoin.
And let me ask you this a different way. Are the factors driving interest in Bitcoin today the same factors that have been driving interest, let's say the past 6 months, 18 months ago?
I think 18 months ago, no. I think 18 months ago, it was much more of this is just a replacement for gold. Maybe I should own a little bit. I think since March, right, since we had the real panic around the pandemic, and since we started to have the monetary policy that we're seeing here, where trillions and trillions of dollars just keep getting added, I think there's a real fear of inflation and a real fear of lack of purchasing power, to the point where I almost don't even think Bitcoin's going higher anymore. I think everything else is going lower. And I think that is the change, that people are really scared now of what it means to just hold cash.
And what are your thoughts on the crypto market overall in 2020? Are you expecting outperformance in certain areas, whether it's Bitcoin or other types of assets that could potentially have a surge?
Yeah, I mean, I'm an active manager. I run a hedge fund strategy. So the sweet spot for active management is when the opportunity set is growing, but the competition is not. And that's where we stand right now, right? There's not a lot of new entrants to the rest of the space outside of Bitcoin. Everyone's rushing into Bitcoin, but the rest of the space is growing and nobody even knows it exists. So where we're taking advantage of, in addition to digital money and Bitcoin, we're looking at NFTs in gaming. NFTs stand for non-fungible tokens. This is equivalent to like pieces of art or baseball cards, things that are unique, right? Where it's like, if you own 1 Bitcoin and I own 1 Bitcoin, that's the same, that's fungible. But when you own a non-fungible token, it's different and unique. And blockchain is enabling you to put a lot of these unique assets in a digital form. And there's going to be an explosion from in-game items in gaming to digital art to digital mortgages, things like that. We're also really looking at another theme that we're taking advantage of is what we call the digitization of the fan experience, right? Sports fans, music fans, artists, etc. They're connecting through social media directly to their consumers and to their fans, but there's never been a way for the fans to actually support them and profit off of that. Through blockchain-enabled assets now, we're seeing it. We're seeing tokens that are linked to Juventus and FC Barcelona. We're seeing tokens that are linked to popular musicians. And these are going to have economic value, and we're investing in that as well.
That's so interesting. And it goes back to your point before, bridging that inequality gap. It'll let, only a certain subsect of people can be involved with entertainers and with sports teams and so forth. Not everyone has the ability to access the capital markets and raise a few billion to buy a sports team. So that goes back to your original point.
Yeah, I think digital assets are the greatest capital formation and company bootstrapping mechanism that we've ever seen. And the capital markets, as we know them, are going to be flipped on its head once companies and individuals understand that digital assets really can bridge the gap between your consumers and your users and your investors.
All right, Jeff, great to catch up with you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.